Do you want to protect your retirement portfolio from the risks associated with tariffs? Well, here to talk with me about that is David Mara. He is the co-founder and chief investment officer of Markin Asset Management. David, welcome.
Well, thanks for having me on, Bob. It's a pleasure to be with you.
Yeah, it's a pleasure. And as you know, tariffs are in the news and people are very worried about them. And before we talk about how to protect your portfolio, maybe it's worth talking a little bit about the risk associated with tariffs.
Yeah, sure. Because there are a lot of, that's a good place to start, because there are a lot of risks associated with tariffs. I kind of think of tariffs roughly bucketing the risks into four kind of buckets. I mean, the first and most relevant one for investors is it places downward pressure on things like earnings, valuations, and ultimately the returns that you're going to get from risk assets, right? Equities. I think the numbers that we kind of look at based on various analyst reports is that about every 5 percentage point increase in U.S. tariffs, it reduces EPS, earnings per share, by about 1 to 2%. And that means that just the announced tariffs get you to about a reduction of earnings of anywhere from 2 to 4%. If it's sustained, that's assuming it's not really sustained very long. If it's sustained, you could see a drop in earnings along the lines of 5%. And earnings is what powers returns, right? Earnings and valuations, but valuations right now are very full. So that's essentially the engine of the earnings economy, if you will. Tariffs can put a lot of pressure onto that.
Yeah. So that 5% near term downside, that's in addition to the downside that we've already experienced in recent days.
Well, yeah, I mean, it's inclusive of it, I would say. It hasn't shown up in earnings yet because these things take time, but it would start to show up next quarter.
Right. Other risks that we need to think about?
Sure. So I think the second bucket that I kind of think about is trade policy retaliation. Right. So, it's in a very simple world. You say, I'm going to put tariffs on you and I'm going to get my benefit, but you're just going to pay a penalty. But that's not how it works in reality. Right. Countries retaliate. And we saw with the very first round of tariffs, there's a huge amount of uncertainty here, but we saw for the very first round of tariffs, as soon as we placed something on Mexico and Canada, they immediately retaliated. Right. China has done the same. You're going to get retaliation, and that's really an unknown, right? What we do know is that, U.S. company exports, right? U.S. company business, about 28% of the revenues of the S&P 500 are from overseas. So if they put tariffs on our goods and services, that 28% is what's directly at risk from retaliation. That's a very large number. That's why, investors are very, very concerned about, endless trade war spirals, that, you think you make a first move, somebody makes a second move, you have to make a third move, back and forth. And pretty soon, you're really hurting earnings in a big way.
Right. And then in terms of its effect on GDP here in the U.S.?
I think we're looking at anywhere from about 0.2% to about 0.5 percentage point lower GDP growth. And we see that recently showing up. It's not going to show up in GDP growth yet, but we see that recently showing up in long-term bond prices, bond rates. So long-term rates have come down a lot recently, about 50 basis points in the last few weeks. And the long-term bonds rates are really about your growth, right? Those rates remain high if growth expectations for your economy are high. That's the bond market signaling we're killing long-term growth with tariffs. So again, these things can change if the tariffs don't go into place, if we don't get into a trade spiral, if we don't get retaliation, and this all kind of gets negotiated, it could roll back. But that's what's going on right now, and that's what's injecting uncertainty into markets, and markets are then pricing that into less growth moving forward.
Right. And as we're recording this, I believe President Trump recently said that he was going to put a tariff on copper, a commodity You have some thoughts about how tariffs might fuel volatility for certain commodities?
Yeah, I mean, it really commodities. It fuels volatility for everything. It fuels volatility for bonds. It fuels volatility for equities. It fuels volatility for commodities. I mean, I think the commodity hedge, if you will, in an environment like this, for thinking about retirees and kind of trying to build a portfolio to hedge these risks, is that oil and gold are really key assets, right? Those are things that will tend to help you in an uncertain environment. If there's an energy shock, oil prices will go up. That's a hedge. In the event that there's more uncertainty, as we've seen, gold price tends to move up. So it's an uncertainty hedge. So commodities, you got to be very, very careful. You got to know what you're doing. I wouldn't advise somebody doing that on their own. I think that it's better for them to work through an asset manager like myself. But nevertheless, because they can get whipsawed quite a bit. But that's the general idea behind those commodities in times like this.
Right. And tariffs hurt other sectors as well that we haven't touched on?
So sectors, you really have to think about this kind of uncertainty as affecting kind of sector rotation. Sector rotation means there's uncertainty. That means we don't know how we're going to respond. It's unclear what the administration is actually doing in terms of next steps, like what the next announcement is going to be. And then it's unclear what the retaliation is going to be. Given that, you're seeing these sector rotations. In recent days, we've had rotation out of cyclicals into defensives in a very aggressive way. But that could also change depending on the information environment and what's going on with these tariffs. So, sector rotation is another potential strategy for dealing with this. Again, it's not the kind of thing. In fact, nothing I have this morning to really add is the kind of thing that the average individual can really actualize on their own, because it takes so much effort to be involved daily, minute by minute. As you pointed out, there was an announcement just a few minutes ago. You have to be kind of on this all the time. But sector rotation as a strategy for dealing with it, and looking for managers, like myself, who deal with that, have tools like that, is one tool in your potential toolbox of kind of funds you should be looking at picking.
Yeah. So in terms of what this means for retirees and how they can safeguard their portfolio, you've touched on a couple things. Maybe you could elaborate on some of those as well and add some.
Yeah, obviously the next one in the toolbox is to think about bonds. Bonds, tariffs do this directly with bonds. They create the risk of inflation in the short run. So that's short duration bonds, things like cash and cash-like instruments. That will tend to push interest rates up there. On the long end of the curve, as I talked about, long-term rates, it's pushing down growth expectations, and therefore it's lowering long-term rates. So depending on where you are in your retirement, whether you're and how you invest, whether you actually buy those bonds outright, or whether you invest in bond funds, which can also harvest the inverse. They harvest the return rather than the dividend payment. You can get very different outcomes. So different outcomes, long and short ends of the curve, and different outcomes depending on the bond strategy that you have. But that's the underlying economics that's going on, pushing up the risk of interest rates in the short run and pushing down long-term growth in the long run.
Yeah. What about currencies, the dollar, the Japanese yen, the Swiss franc?
Right. So currencies, again, if we are going to live in a persistently high tariff environment, that's good for the dollar. It's going to keep the dollar strong. Because we'll be importing less. Hedge currencies, things that do well in uncertain environments, capricious environments, safe haven type of characteristics. Those will be the two other currencies that you mentioned, which is the Swiss franc and the Japanese yen. And, again, currencies, just like commodities, something very difficult to invest in. I generally don't recommend individual investors, particularly people in retirement, doing that on their own, because it's literally a 24-hour market. But those are things to look for and be talking with your advisor or your fund managers about. Am I properly hedged on the currency side? Is there something I can do to protect my portfolio using currencies, using commodities? sector rotation, and then just active management overall, because the information environment's changing pretty quickly.
Yeah. So when you think about these hedging strategies, a lot of folks are want to put a hedge on the downside risk. I hear a lot of people talking about things like buffered ETFs and things like that, where you're limiting maybe your upside growth, but also protecting your downside. Any thoughts about what people should be thinking about with respect to hedging?
I'm glad you mentioned that. When I speak of hedging, because just to clarify, when I speak of hedging, I'm specifically referring to using hedging as a downside risk management tool. I'm not referring to it as like trying to make money off of hedging. Generally, to do that, you have to lever up a lot. You're not going to want to do that on your own. You would do that in a fund environment, but even then, anything levered can get you in trouble quickly. So just to be clear on that, so thank you for mentioning that. Coming back to your question, I don't want to speak to any particular type of ETF. I think that the ETF space is so huge these days, and there are a lot of promises out there about trying to protect on the downside. Let me put it this way. As any investor, whether individual or institutional, you have to know exactly how that thing you're investing in makes money. And if it doesn't make intuitive sense to you and you can't understand it, I don't think it's a good idea. So, when you get into structured instruments, complex instruments, there are very simple things you can do to hedge. Like I said, you can have a certain portion of your portfolio invested in gold, invested in dollar, invested in safe haven currencies. You can align with a sector rotation manager, et cetera. These are simple things that have an intuitive explanation for people, as opposed to getting yourself into a very complicated product where you really don't understand how it makes money, and you certainly don't understand what the risks are, right? So I would just add that to people who are thinking about those without speaking to any particular ETFs there.
Right. So as we're talking, there's a lot of uncertainty about the tariffs. They could be temporary. They could be focused on a few countries. They could be used to negotiate or leverage deals, et cetera, et cetera. How do people sort of navigate this uncertainty of that?
So look, retirement money is the most important money people have, most people, right? They got their house and they got their retirement money because it's what they're going to live on for the rest of their life when they're not really earning much income or any income at all. And you have to make very prudent decisions. I think that outside advisors, wealth managers, advisors, if you know asset managers like myself directly, certainly we can also help fund managers, but speak to people who are professionals. This is a complex environment. It's a rapidly changing environment. These are important funds to you, and you don't want to make rash decisions. You want to make prudent, informed decisions, getting the best advice that you have available to you. I think that's the best advice, that I can give.
Yeah. So David, we covered a lot, bro. Anything we missed or just bears reemphasizing?
No, I think this is a good summary for people. Obviously, there's so much more to discuss, but it's the kind of thing I think people should be discussing, with their advisors and their fund managers.